Hello, ladies and gentlemen, and welcome back. The question everybody's asking right now is, can this market find a Santa Claus rally? Well, 5 days in a row, it's now been down. This starts to enter into historical turnaround events. You don't often see markets fall this many days without some form of respite. The question then is, even if we do get some type of rally, will it continue to do so? We've got the answers in today's video, and more importantly, the reasons why we think that the markets may actually be setting up for further pain ahead in 2023. Well, welcome back everyone to the Daily Show. In today's video, we're going to be talking about the news articles, of course, the macro data, the lead indicators, and the key levels that you need to be watching on the charts moving forward. Let's discuss inflation, because this was the story of 2022. The good news is inflation is dropping. The bad news, of course, rents and food are where the inflation problems have been. But we know that the Fed will want to learn from their mistakes. And the problem they had last time was they cut rates too early, and it caused, of course, a secondary spike in inflation. What will this mean for markets? Well, it's going to put a lot of pressure on earnings. And this is the story of 2023. Earnings, and especially growth stocks. Valuation compression will be a thing, and we'll look at that in just a few moments. Some of the key numbers that you'll need to be watching for that period. So we probably are going into a recession. Very high likelihood if we're not already in one. And I think most of you will agree that it'll be called somewhere start of 2023 most likely. So the S&P 500 quarterly EPS may need to come back down. And this is something that tends to happen as we actually call recessionary points. Now, that doesn't mean that the market itself hasn't already started to value its way into recession. That's the current story right now, but this will be one of the charts. Another chart that you'll need to be watching right now has to be this one here. Follow us at FX Evolution on Twitter as well. We post a whole bunch of interesting and exciting charts like this to make you further and better understand markets around the world. So the big one is S&P 500 large caps. Forward PE ratio. Now, the forward PE ratio is generally the one you want to be looking at, not so much the current PE ratio. And markets in the US tend to like 17. We've now hit that. But what this means is that we're at a point where we expect, if there are earnings declining, that the market will revalue itself to be consistent with 17 times forward earnings. And more importantly, if we get standard deviations away from that, let's say a 14 or even 15, whether that creates a incredible buying opportunity in 2023. This will be one of the most important numbers to be watching throughout the market. So look for forward PE ratios. It's going to be a big one. Another chart that we want to bring up before we go into the rest of today's video has to be this one. Apple versus the S&P 500. The king is potentially, or queen is potentially dead. Now let's find out what happens next. You can see that Apple has absolutely kicked ass over the last couple of years, and it's been holding up a huge portion of the market. You'll see a share here from one of the members over at FX Evolution's Twitter that shares the weighting averages, and you'll notice why Apple is so important. 6.23%. As they remove themselves partially from the supply chain of course, China, and move into India and bring it back to the US in terms of manufacturing, it's putting pressure on the stock as well as valuations into what is most likely a recession. So these lows will be an interesting point, and we've got more on the Apple chart a little bit later on. This is a serious chart and something that we need to be paying attention to. Let's now talk about one of the best trades of 2022, and that has to be the US dollar. The US dollar was king and queen. It was the one that everybody wished to own. It was the best during inflationary times. But as we know now, the Federal Reserve is going to eventually have to cut interest rates to support the economy. And that's putting downward pressure on the S&P 500, and it's also putting downward pressure on the US dollar. Notice the next 12 months, it looks murky at best when we get readings like this. Only 50% of the time is the market bullish or bearish. That's not really a stat that I like. It shows us that there are kangaroo markets ahead. When we get readings like this from the US dollar, it also usually shows a very interesting next 2 to 3 months for stocks, with the usual positive statistics becoming more blurred. You've got to remember that whenever we look at statistics, anything sitting around 50% of the time bullish or bearish actually is quite negative, because markets tend to be 60, 65, even 70% of the time bullish over the long term. If we look at percentage returns from the dollar index when this happens, and of course, what other sectors tend to do well, this is a great chart just to pause if you're interested in finding out what does well around these times of dollar kangaroo style sideways or weakness. And of course, we have the chart here that we used only a few days ago to show us that the top was most likely in, and that was the MACD switch with the 200-day moving average decline. 1 week, 2 weeks, 3 months, and 6 months later, very poor statistics with the data reads that we have for the S&P 500. And it helps us to kind of build this evidence that maybe there are more problems ahead, even if the market does partially rally here into the end of the year. Now, the question everyone's asking is, does the market rally into the end of the year? Well, during bear market years, the answer is no. Traditionally, yes. And traditionally, actually, the market starts to turn around that 16th of December into 20th. A lot of people call the Santa Claus rally after, of course, Christmas into the new year. Look, I don't really care how we look at it. The main thing is that around that 15th, you tend to see the low of markets and then a recovery. This is not proven during bear market years. So I think taking the statistics into account here shows us that while we may get a pickup, it's not really probably going to be a traditional Santa Claus rally, at least statistically. Let's move over to the VIX now and have a look at what's going on here on the markets. And you'll notice straight away that we have a little bit of a down day on the VIX, even though the market sold off. A lot of people think that's crazy or it doesn't make sense. Remember, this is still an incredibly high number. Whenever the VIX is above 20, it shows an incredible amount of fear in markets. Realistically, the VIX will generally spike when you go into uncharted territory. That is new lows on the markets. That's what you're looking for. When you're just kind of going down in a zone that's already traded before, the VIX will stay high. It may even spike a little bit, but it won't go in these huge, big pickup zones. So expect a lot more capitulation needed before the VIX will actually spike to 35 or anything like that again. Let's take a look at one of our lead indicators, and that has to be high yield bonds. This helped us to show that most likely we were going to see sell-offs, and they continue to be the weakness here. This is junk bonds. So no one wants to own junk. Junk is becoming more of a concern when you compare it to corporate bonds or even TLT, we'll look at in a second. And we're getting very similar high zones to what we've had before during some of these bigger sell-offs of the stock market. Remember, this should be going with the direction of the stock market down, not against it. And if it goes early, which it almost did this time around, then that gives us those precursors that things are not good in the market themselves. TLT has also suffered from this. We've seen yields slightly increase, risks across the board increase as well, and TLT treasuries have come down. I don't think we need to be too concerned about treasuries, but a nice healthy pullback would be in order. And because of the structure we set here, we'd love to see it come back into that 100 or even 102. Treasuries has become a stacked trade. Everyone's talking about bonds. It's probably the most I've ever seen anyone talk about bonds in well over a decade, ever since the GFC actually. And that's pretty surprising. Bonds are back in focus, and TLT is one of the favored by retailers and major investors alike. Let's have a look at the US dollar. We're talking so badly about it, but at the same time, what do we think about the current trend? Well, the good news is it's kind of trying to break out of this downward action, and we are at this stage mediumly bullish on it. So what that means is that it hit really critical lows. Let's just have a look at those together. Here are the critical lows. It's bounced up, which is great. We've seen a resistance here around that 104.50, and then we have some new levels that, of course, we expect the DXY to potentially get to. That 105 kind of 20 zone, that's going to be a big one there for the bulls. We'd kind of like to see it do something like this. If it breaches through here, then come back later and then maybe have a little bit of a resurgence. That doesn't mean that we think the US dollar is going to 120 at this stage. We probably don't. But what we do expect is some good trading from it over the next couple of weeks. And at this stage, the DXY is trying to mount a comeback in what is a pretty bad downtrend for it. Now, what's that led on to? Well, it's led on to gold doing okay. This was the trend line that we had, that we saw break. It respected it over the last 24 hours. And I did want to see gold go up to that 1805, 1808. I was pretty patient there for a short. Didn't do it yet. Obviously, it stopped right on this trend line and made a new little low here. This could be all we get from gold for, the tighter kind of time frame traders that are looking at really small time frames. They might be checking this out and saying, well, I'm going to now try to short, somewhere in here around that 1795, basically a pullback in the markets, hitting this level and then looking for further weakness. It started to set up. We've got those highs, lows, higher highs, and then we made lower lows. We've broken some structure. And at this stage, a rally early in the session could certainly be met by sell demand. That's at least what we're looking for in gold. And the main reason has to do with what we're seeing across the board, which is potential distributions. False breakout over here, max pain, whatever you want to call it. And then we get a new low later on, which will show us that gold wants to go low. Now, we are bullish on gold and silver over the medium term here into the first quarter and maybe even second quarter of 2023. But at this stage, we do think that there's real potential for a little bit of a pullback first. Take a look at silver here on the charts, and you're going to see clearly why we think there's a pullback potentially coming through. But at the same time, you cannot ignore the base on silver. It's one of the best bases I've seen in quite some time. Let's move over to oil. Oil is rallying here. Everyone's now talking about the negativity on oil. Yes, this was a great zone that we spoke about shorting. I'm just a little concerned for it to go short here any further. And the reason is because I think most people now have this technical chart drawn. And while we were early the other day, I'm not sure if we are anymore. So this was a great short. It did go through. It then kind of found itself. And at this stage, it's putting pressure on the downward trend. Levels to watch, especially if you're bull on oil and you like the risk reward, somewhere around that 78 level. If it does break through there, you've got to like what you see. And that's because the market made a low here. It breached through this level. It's pulled back. And I could seriously see it continue on here all the way up to 82 a barrel. While I still maintain 65 a barrel eventually, sometime over the next months into 6 months, it doesn't mean it has to happen right now. Trend is still down. Overall, though, some breakouts could happen, and be careful there. Let's move to the elephant in the room, and that's Tesla. Of course, Elon is currently voting on whether he should step down as the head of Twitter. Most people are voting yes, and we do know that the pressure has been on this stock. Now, it did look, and I tweeted about this, that 150 level on the previous open looked okay for the market because it was finding that little bit of resurgence. I'd still like to see, realistically, Tesla put in a couple of nice days, pick back up, and then move back down to that 136, 123, which is our eventual destination. There's a gap over here that's been left on Tesla for quite some time. We've been negative on it. We still maintain negativity. But I could see potentially a little bit of a resurgence once that vote goes through and he announces that he's probably going to step down as the head of Twitter or whatever's going on. Shareholders just want something positive to look at. Now, let's have a look at the options to see if that makes sense. Well, first up, we'll go to the 23rd. Maybe it doesn't make as much sense considering how many people bought calls over the last 24 hours. 160, but that's still $10 below current price. Is this Friday's options expiration. But the interesting options expiration has to be the 30th of December. This is going to become an interesting point. 160 puts sitting there, and certainly something that we will be watching and just having a look at over the next coming weeks. Let's move over to Apple. Yeah, it's not good. This is the stock that everyone's talking about. New lows being formed, and this is all before the last time, 37.50. Clearly, Apple is coming under valuation concerns. We talked about these series of lower highs being very negative for the stock only just recently. This closure is not great. Any rally you would have to expect is met by sell demand at this stage based on the fact that closure did happen underneath these zones. And while it may have filled some gaps, which gives it the potential to rally here over the next 24 hours, we'll talk about that later. We do think that if it comes back and fills the gap that's up here, it hits that downward trend line and kind of gives a very strong case to then potentially see some further selling in the stock markets. Have a look how well that would line up. Here's the sell, here's the gap close. Let's pop that on the charts. Of course, we have that downward trend line. Let's just, for use of this example, say it takes a couple of days to get up there, we spike that level, and then we come down. Does that make sense? Well, it's certainly a very interesting scenario here for this stock. Let's look at another one. That's Amazon. You cannot love this chart at all. That was a horrible weekly. We got a donation during the live stream last night. Someone wanted to know about Amazon. I really like it over the medium long term as an investor, but as a trader, geez, you can't like that particular position there. Now, where are the lows? Well, interestingly, we're approaching the low that was formed during the pandemic. I'm going to set a little alert there because these are the types of levels that you would hope markets actually do bounce off. Now, this is still a few more percentage points away. Let's have a look here. So we're looking about 4.71 percentage points away. And if it does end up going down there in the future, you've got to expect some buyers to try to commit themselves around this level. That's one of those critical points that executes a whole bunch of stop losses, puts the squeeze on, and then potentially rams the other way. Very key level here for Amazon. I had to bring it up on the charts. Another one that looks really bad is, of course, Google. We see that distribution, that false breakout over here, that rally that came up, and of course, we're now about to gap fill and close that level. This is, again, just the problem with the US stocks right now. Concerns about forward earnings. Well, could we see further selling in the US after a rally into first quarter earnings? Well, remember, this one here, 42 days away, we've got earnings for this stock. Amazon is 44 days away, and Apple is 37 days away. So we have a whole bunch of major stocks coming in. Remember what they say about buy the rumor, sell the fact. Is this a sell the rumor, potentially buy the fact? So many companies making expensive plays to de-globalize themselves or to fix their supply chains. It's starting to come through in the valuations. Apple versus S&P 500, we talked about it based on our Twitter send off here. This is the first time we've seen weakness in this particular ratio in a very long time. And it just, again, this is the biggest stock in the US market. It's the biggest stock in the world. If it falters, the rest tends to come with it. Let's have a look at the DAX. I really love that distribution. Really think it's amazing. That false breakout, beautiful thing. Again, I favor the idea of a rally that's met by sell demand later on. That tends to be the way that usually these distributions play out. Sometimes they're explosive and they keep moving down, but eventually you usually get a pullback to these areas. Have a look at Russell 2000 or even the weekly DAX back earlier in the year where we had that distribution. We saw a huge sell-off. It came back and it gave a second chance sell-off in that zone. So don't feel FOMO, patience, react, don't predict. That's one of the big things that we look at here. Consumer staples and consumer discretionary. Discretionary is absolutely getting destroyed at this stage. Just shows you how bad the market believes the economy is and that the Fed will have to support it. Here's a case for potentially saying that there is some type of rally potentially coming through in the next couple of sessions. Not only have we had many sell-off days, but the Dow has actually hit the bottom of that trend line. This is a very stacked trend line on the way up. You can see the market reacted to it. It's now hit the bottom plus the 200 daily moving average sitting around here. And maybe that's due for a little bit of a rally followed by some sell demand later. Dow, certainly one that we're watching. Nasdaq, does it show us anything? Not really. Nasdaq's been quite weak. Need to probably clear this level here price-wise. You're looking at that 11,300 now to show us that any potential rallies could be in. At this point, it's still negative. And that's what I really want to state here. There's no actual reason to not be negative on the markets on the small time frames yet, except for maybe the Dow hitting that level. Let's go over to the S&P 500. As we mentioned, 1, 2, 3, 4, 5 days down in a row. If we look at history, here's 1, 2, 3, 4, 5 days down in a row and actually based and it found a little bit of bullishness. And if you go over here, 1, 2, 3, 4, 5, and then a little bit of bullishness. Traditionally around that 5 days tends to be that point where you get some form of rally. It doesn't mean it's a huge rally, but you get some kind of respite. The markets are a little bit oversold here. And while we expect markets to recover and then potentially sell later on, well, that's actually the main case we're looking at. I'd love to see it go back to that 4,000 and then sell from that point. That would be fantastic. We still would love to see 3750, but why not give us a 3580 as well? The gap that was left all the way down these lows. Imagine this per se, we go up like this. People think they're going to get this price. Maybe they will. We'll find out. Then it sells off, gets the 37.50, bounces a little bit, sells off 35.82. We find out what happens there. That would be pretty sweet in terms of a nice trap from Wall Street, and certainly would work within some of the boundaries of the options moving forward. I also favor the idea that the market rallies at this point because around that gap close is now also the golden pocket. So a pretty fantastic level should the market come back up to this to find further sells. And it also helps us to really show that downward trend line that comes through all of those previous points. The one was here would most likely be intersecting with it at the same time. So if we took a downward trend line like this, it would be hitting into the same area. Notice how that would be similar to Apple. Just a thought process, but something that we always do think about here on the channel. Make sure to subscribe and smash the like button if you're enjoying or like those types of things. So what's the next 24 hours bring us? Well, at the moment, it's making a series of lower highs and lower lows. There's nothing here to say that there's a turnaround just yet. If we do breach this 38.80 though, that's going to be key. So 38.80 and 39.10 are the two main levels. We breach that, we pull back a little bit, and then ideally we rally into something like this 4,000 zone, fill the gap, and then potentially sell off. This is one of the better case scenarios, but for people that are bearish, look, you're probably just still angling in for that 37.50 to even 3,700 level. That's what you want. You've hit now the first zone. 3,800 was a great zone, but will we now go down into the other one where the gap close would be? Well, I would suspect that market could definitely do more of this type of thing before eventually getting there a little bit later on. At least that's based on the fact that we've had 5 days of selling in a row. Let's have a look at the options expiration here onto the Fridays. If we go to the 23rd, there's not much open interest. Obviously, 1 million units is not that much. And if we go over to where we see all the puts, makes sense why the market couldn't go too much lower right now. We're seeing 380s and 375s with the biggest strike numbers. And there's still 60,000 plus options open on those levels. Let's move over to the 30th. And this is actually a pretty big options expiration, 2.5 million units. Surprising how large it is coming into the back of the year. Again, 380 and 375, these are the put walls. It seems unlikely coming into the back of Christmas and the end of the year that the market will wish to be underneath these zones leading into that options expiration. You would ideally want to be somewhere between here and 400. That smiley face, the perfect example for what Wall Street wishes to do, and certainly something that I think a lot of people will be looking at. Let's move over to Bitcoin. Still looks pretty bad. Obviously, any rallies you would think of be met by sell demand at this stage. Could this be a huge pullback in the direction with a rally? Well, if you're looking for the bull side, you want it to break through that 16.9 area. And once that happens, then you're looking forward to a little bit of a rally and then maybe sell off later on. Again, in line with the market, probably will follow the S&P 500 a fair bit on this one. For the news week ahead, what else do we have? Let's just quickly scroll through here so we can see it. Not too much information coming out this week. We've got CB consumer confidence, obviously Wednesday, 10 a.m. New York. And the big one that the Fed watches here, core PCE price index, 8:30 a.m. on Friday. So that's probably going to be the most volatile period for this week so far. It's a very technical market. There's some great opportunities, and we hope that you follow us along over the next couple of weeks while we head into Christmas and obviously a period of illiquidity, but sometimes some extreme volatility. Thanks so much. Bye for now.